I'm going to be uncharacteristically upbeat this morning, and the theme of my talk is the economy is slowly ramping up. We think the economy is positioned for real growth. In a sense, we're going to be going from the 2% world we've been used to a 3% world. Not great by historical standards coming out of a very deep recession, which would be like 4 to 6, but a lot better than the 2% we've been used to. Housing and autos are continuing to gain strength, despite all the stuff coming out of Washington and what have you. Housing gets better every month, and automobile sales get better month by month. There'll be a recovery in business construction and exports in 2014 and 2015, and I'll get into that in a bit. However, near term, there's some risks that are holding things down. I'll talk about that in a minute or two. There's some risks holding down. So 2013 will still be a 2% kind of world. But once we overcome a few of the hurdles, we'll be in a 3% world thereafter. And one of the places where we do differ with consensus is we think there'll probably be a little bit more inflation in the mix than what we've been used to. And that's most notably going to be coming from rents and what's called owner equivalent rent in the housing, on the housing side. That'll make core inflation probably a little too high for what the Fed would want. I mean, the near-term headwinds everyone talks about sequestration. So far, this is the president's word. It's not apocalyptic. The sequestration is not apocalyptic. The only two things that seem to have happened with sequestration is that 8th graders can't go to the White House for tours, and if you want a snowmobile in Yellowstone National Park, you might have a problem this year. But we may have some problems in March and in April and May with this. But our sense is Congress is going to make a deal, and it won't be all that bad. So we have federal spending dropping a bit in the second quarter and rising in the third quarter. We think there's going to be a deal made, similar to what happened with the fiscal cliff in December, January. The other headwind is that Europe and Japan are in recession and probably will remain so for most of the year, and that makes it hard to export. We're facing higher payroll taxes and higher earner taxes, but today we've got retail sales numbers that were very strong for February, and that's even with federal withholding federal tax refund checks being delayed. Retail continues to be very strong, well above consensus in February. So retail seems to be doing well. There's temporary weakness in business construction, and when we mean by business construction, we don't necessarily mean office buildings and shopping centers. We mean natural gas rigs and utility power plants, and that's going to be down this year. It's putting a pause in business construction. That will then go through the system, begin to ramp up again in 2014 and 2015. And then lastly there's going to probably be some issues associated with implementing Obamacare or the Affordable Care Act. And some workers maybe who are now full-time might become part-time because less than 30 hours, those workers are not covered. And also where you have 50 or fewer workers in a firm, they're also not covered. So some firms may decide to stay below 50, or if they're above 50, to go below 50. So there may be some issues about that. In two of the Federal Reserve districts in the Beige Book commented that this could be an issue later in the year. That may hold back not necessarily employment, because you may get more employment because you have more part-time workers than full-time workers, but it'll certainly hold back income. And so I think that could be an issue later in the year, because this is a big deal and there'll be a lot of transition issues associated with implementing the act, which takes effect in 2014. All right, here's our GDP forecast. We had essentially no growth in the fourth quarter of last year. We have about 2% for the first and second quarter of this year. When federal spending goes back up, with the sequester, but it's not spent in the second quarter, it'll be spent in the third quarter. So it's a little cute, but we have an increase in the third quarter. Levels off in the fourth quarter, but in 2014, 2015, we're looking at consistent 3% growth, 3% plus or minus in 2014 and 2015. So GDP looks a lot better than the 2% that we've been used to. In terms of employment, we're going to pass the 2007 peak. In terms of job numbers, what we're implying is this year about 180,000 jobs a month, same as last year. Next year about 200,000 jobs a month. In 2015, 220,000 jobs a month. That's what's sort of built into the forecast right now. a lot better than the 150,000 we're used to in 2010 and 2011. So the employment picture is getting better. Not great, but getting better. And that will bring unemployment down below 7%. We have it at 6.5% by the end of 2015. That's the Fed's magic number for raising interest rates and what have you. We have it happening later than what they have, but there's a clear downward trend in the unemployment rate that looks like will continue for the next couple of years, and we get back to where we were in 2007. So that's also good. Not great. It's not going to be 5.5%. Or 5% where we started, but still a lot better than the 10% where we were. All right. In terms of housing starts, housing is which led the downturn. Housing is going to be leading the upturn. We will double from the low from about 500,000 starts in 2009. We're going to have about 1 million starts this year. That's just a touch above consensus. Where we are above consensus is in 2014 and 2015, we're about 100,000 units above consensus. We have 1,350,000 next year and 1,500,000 or so in 2015. Housing is getting a lot better, and a lot of the increase will come from multifamily as opposed to single family. And we'll be making new highs, new cycle highs. We'll go above 2006 and 2007 level for multifamily by about a third. And single family is also rebounding. But so housing, we think, is getting a lot better. The reasons is affordability is the best it's been in a long time. We have generally prices are low, interest rates are low. And we also think housing could take a hit from higher rates because we'll have house prices be going up, will be rising again. So we think the market will absorb higher interest rates. In terms of cars, cars are also rebounding off the low. And we're going to have 15 million plus this year, and we're on the road to 16 million units. And a lot of this is really replacement demand. The average age of cars on the road right now is 11 years. It's the oldest the fleet has ever been since we've been keeping records on the automobile fleet. So just replacement demand. I mean, cars just wear out, they fall apart. In Southern California, not so much, but in the Northeast and the Midwest, where there's snow and salt on the roads, the bodies sort of fall apart a lot quicker than they do here, and we just have basic replacement demand for automobiles. So automobile sales are strong and are getting stronger. And this is not aggressive. If anything, we're a touch below consensus on this, not above consensus. So we think this is a pretty good bet. Here's our business construction, essentially flat in 2013. So we're up roughly 10% in 2012. We'll be 0 in 2013, then we'll have 10% real growth in 14 and 15. That comes from rebound in commercial construction, as we understand it, is shopping centers and office buildings. And also we'll get a rebound in natural gas drilling and oil drilling in the country, which is leading to charge. Ed will show a chart later showing about how strong the mining employment has been. And mining employment is really oil and gas, basically oil and gas wells. Okay. In terms of exports was the theme of the conferences. We have exports growth to be weak. We peaked it up 10% in 2010. We'll only be up about 2% in 2013. It is very hard to export when your major trading partners of Europe and Japan are in recession. And as long as they're in recession, it's just going to be a very tough environment. We're assuming they come out of recession in 2014 and exports begin to rebound. The issue with exports is the yen. Right over here, Mr. Abe, the new Prime Minister of Japan, made a statement saying they're going to do quantitative easing. He made one statement about he wants the yen to come down in value, so this is the dollar going up against the yen. We've had a 20% devaluation of the yen in the past 3 or 4 months. This is going to make it harder for the Chinese to do anything. The Chinese are accusing the Japanese of currency war. What it will make it hard for American companies who compete with Japanese companies to compete with them because the Japanese goods all of a sudden are 20% cheaper in dollar terms. Now, the plus side for us is oil is priced in dollars. Japanese demand, the price of oil has gone up 20% in yen terms, and they're going to demand less oil, so that may put some downward pressure on the price of oil. So that's a positive, if you want to call it. That's a partially offset the problem we'll have with exports. If we have a problem in the global trading system, in the global financial system in 2013, the origins of that problem is this move in the yen. And every hedge fund in the world has this trade on where they're short the yen and long the dollar. So this could be 110 and not the 95 pretty soon, because there is serial correlation in currency markets. If not in the stock market, there is serial correlation in currency markets. All right, this is sequestration monster. My guess is it's not going to be as bad as they say it's going to be. It's not going to be apocalyptic. And to me if the president wants to, on the defense side, which affects Southern California, last I looked, the president is the commander-in-chief of the Army and the Navy, and he could do whatever he wants with respect to military if he chooses to do that, or if he wants to. So he could use a scalpel rather than a meat axe to deal with the defense cuts if he chooses to. And my guess is a lot of that you will see in both the civilian side and the military side. They'll be more serious about the cuts and not use a meat axe type of approach. So, but the thing is that this does introduce some instability in federal spending. We had a big rise in the third quarter, a big drop in the fourth quarter, and then we have a drop here in our second quarter, a big rise in the third quarter. But the fact remains is that once we go through these cuts, the purchases, government purchases are on a downward trend, and will be a downward trend for the next several years. Now, this does not include Medicare, Social Security, Medicaid. Does not include transfers. Purchases are the FBI, the Department of Defense, the Federal Aviation Administration, the Department of Commerce, the Department of Justice, the things that the government, normal governmental functions, not the transfer payments. If you really want to look at the federal government really is, if you really look down at the budget, is an insurance company with an army. That's what the federal budget is. It doesn't do anything else. It makes payments to people. It makes old age insurance payments. It makes health insurance payments, and it protects us one way or another with the military. And the rest of the budget, this has the military in, but the civilian part of the budget is really very, very small, and that is continual. That's going to be squeezed, and the military part of the budget is going to be squeezed. Interesting enough, in the Ryan budget that the Republicans proposed yesterday, is their caps on defense spending for the first time. So it looks like that this trend is baked in the cake, that real purchases, real federal purchases, are on a downward path once we get through this blip with the sequestration. Now, the thing is in terms of long-term fiscal imbalances, what they do is they just kick the can on the road. There's the president. Holding the ball is Boehner. You got McConnell and Reed blocking and stuff like that, and they're kicking the proverbial can down the road, because even with all these cuts in in federal purchases, the long-term deficit of the country begins to rise starting in 2019, 2020, 2021, is because the entitlements ultimately eat up the entire budget, which is Medicare, Social Security, and Medicaid, and until that gets under control, there's a long-term structural imbalance in the federal budget. Now, we think inflation is more of a risk. We have inflation going over 2% in 2014, which is the Fed's target. And the cause of that is a rise in residential rents. The real surveys of what people are paying for rents, tenant rents, not owners equivalent rents, and what the publicly traded apartment REITs are reporting are showing rents going up at 4 to 6% annual rates. The government data, the CPI data, is showing 1.5%, 2% kinds of numbers. We think ultimately the real increases in rents are going to start flowing through into the official data, and that will begin to raise the official CPI. The other thing is owner's equivalent rent is a kind of a cosmic concept. They ask somebody, if you had to rent your house, what would you pay for it? And who knows what the answer to that is? What would the rent be? But now we have a whole bunch of companies, private equity firms, that own thousands and thousands and thousands of houses. And you have a real market developing for renting single-family houses, so we're going to have much better data on single-family house rentals. And my guess, that's going to start flowing into the data. And we're probably going to see higher increases in core inflation than what the Fed is now looking towards, which means is given with very, very low productivity, which Steve and Ed will talk about later, is will give us, and lots of helicopter money. Let me go back. Let me go forward here. will give us higher rates going down, and will give us higher interest rates in 2014 and 2015. We have the Fed tightening in December 2014. Most Wall Street has it in the middle of 2015. And we have 10-year treasuries normalizing in 2015 at around 4%. Now let's go back to, this is what the Fed's been doing. From 1914 to 2008, which is the whole history of the Federal Reserve System, the Federal Reserve only got up to $800 billion as balance sheet. And in the past 4 years, we've gone from $800 billion to $3.2 trillion. We've quadrupled the Fed balance sheet. So we have the whole history, the 100-year history of the Federal Reserve to $800 billion. In 4 years, we go up to $3.2 trillion. There's QE1, QE2, QE3. They're on track for $4 trillion at the rate they're expanding their balance sheet. Ultimately, this stuff is this kind of monetary stimulus, along with the lower productivity, along with these issues we have built in with rents, is we're probably going to get a little bit more inflation than what the Fed is now looking for. This is above consensus right now, and that will probably mean higher rates a little sooner than what the markets are now anticipating. Now, people will say as well, you know, we haven't seen it yet, but last June the 10-year Treasury was 1.4%. Today it's around 2%. We could see the 10-year Treasury, say 2.5% by the end of the year, 3.5% the end of the year after that, into the 4s thereafter. So the message here is, if you want to refinance your house, I would do it sooner rather than later. All right. To conclude is we think the economy is getting better. We're going to overcome the negatives of 2013. Just remember, we overcame the big fiscal cliff where everything's supposed to be bad. Fiscal cliff resolved itself. Sequestration will resolve itself. Europe will be out of recession by the end of the year. Housing and cars are sort of chugging along. Business construction is going to pick up, is going to get better. Exports will be a little bit better. We may have a little bit more inflation in the mix. But our sense is we could have the economy will, not great, but 3% will be a lot better than 2%. And 220,000 jobs a month is going to be a lot better than 180,000 jobs a month. And 6.5 to 7% unemployment rate is going to be a lot better than 7.5 to 8% unemployment rate. So the world is getting better. Thank you very much.